Hey everyone, welcome to another video by Stocktrades. My name is Matt, and today we are going to once again look at Canadian Dividend All-Stars that are expected to raise dividends this coming week. And we're going to get to that right after this. As we talked about at the beginning of the month, February has been a very busy month for dividend growth. And this is a good sign because last year there were more than 80 Canadian companies which cut the dividend, 12 of which were Canadian dividend aristocrats. So it's nice to see that so far February has unfolded pretty much as expected. There were very few surprises, with the exception of, I would say, one notable surprise, and that is Toromont. Toromont has the third longest dividend growth streak in the country, and it failed to raise dividends along with its regular pattern. So that will be a company that investors will want to keep an eye on. I'm almost 100% sure that they will come through with a raise at some point this year, but right now their dividend has been kept steady given the current economic environment. This week we have a trio of all-stars that are expected to raise dividends in the first week of March, and all three of them are, to be honest with you, quite suspect. Why? Because they have all been impacted by the pandemic in one way or another. And we'll get to our first stock, which is Chartwell REIT. Chartwell Retirement Residences is an owner-operator of retirement and long-term care communities. The company has a 6-year dividend growth streak and typically announces a dividend raise at this time of the year, in early March. Historically, the company has raised dividends in the low single digits. In fact, it has raised the monthly dividend by approximately 0.001 cent every year throughout the streak. Given this, investors should not expect anything more than a similar raise this time around. This is especially true given our current environment. Long-term care homes and retirement residences have been particularly hard hit by the pandemic. In some areas, the spread of COVID-19 within these types of communities has been absolutely devastating. In December, the company did provide a corporate update in which it pulled fiscal guidance for both 2020 and fiscal 2021. Likewise, occupancy rates have been hovering between 81 and 82% over the past year. On the bright side, it has collected, and I quote, substantially all of November and December rent and service charges. Through the first 9 months of 2020, funds from operations dropped by 17.6%, and the dividend accounted for 80% of FFO, primarily as a result of higher costs brought on by the pandemic. All things considered, don't expect Chartwell to raise above historical averages. If anything, there is a high likelihood that the dividend is actually kept steady this month, which would not be all that surprising. The company is being impacted by the pandemic in a pretty significant way, so this is one that's really up in the air as to whether or not the company will extend its dividend growth streak to 7 years. Next up on our list is arguably the best oil and gas company in the country, and that's Canadian Natural. Before we jump into Canadian Natural, I just want to spend a couple of minutes talking about real estate investment trusts in general. They have been among the hardest hit, and there have been a dozen real estate investment trusts that have cut the dividend this past year. In fact, they have also been the last few that have cut dividends in actually 2021 and the end of 2020. So the pain in the sector is not over yet. There's still potentially more cuts to come in the real estate investment trust industry. Think of retail REITs, office REITs, potentially retirement residence REITs. So it's something to keep an eye on. Let us know in the comments below what you think about these types of companies right now. Personally, I'm not touching any of them unless they're in the industrial area. This is probably the one area which is least impacted by the pandemic, and in fact it's actually growing as a result of the pandemic. Outside of that, not really interested in touching real estate investment trusts at this point in time. Okay, so speaking of hard hit, the energy industry is actually the hardest hit throughout the pandemic. There's been more than 25 companies which have cut the dividend in the energy sector. Many high-profile companies. One company which has not is Canadian Natural, and it's why we think it is one of the best companies to own in the industry. Last year, the company raised the dividend just before the pandemic at around this time of the year, and it effectively extended its dividend growth streak to 20 consecutive years. This is a very impressive dividend growth streak, and we actually expect the dividend growth streak to continue this time around. Why are we confident? Because Canadian Natural is one of Canada's lowest cost producers and quite simply a best-in-class oil stock. When notable peers such as Suncor were slashing the dividend last year, CNQ stayed the course. And now that prices have rebounded in a pretty significant way, Talks of a dividend cut have now subsided, and we could potentially now turn our attention to dividend growth again. Canadian Natural has averaged around 13% dividend growth over the past few years. Can this be sustained in 2021? You might be surprised, but the company still has a very respectable payout ratio against cash flows. This is one of the big benefits of being a low-cost producer. That being said, I'm going to be a little cautious here. While I do expect a company to come through with a dividend raise, I don't expect it to be in the double digits. I'm going to expect Canadian Natural to come through with a raise in the mid to high single digits. Remember, this is a company that is a low-cost producer. Its break-even is at WTI prices below $30 per barrel. So given that the price of oil has spiked in a material way, we think Canadian Natural is actually well positioned here. It's generating considerable cash flow, and the dividend is well covered against those cash flows. We just don't expect it to be double digit like its historical averages. It might surprise us, but at this point, any raise would be welcomed by dividend investors. The last company on our list is also in the energy sector, is Parkland Fuel. Parkland has an 8-year dividend growth streak and is one of North America's largest and leading fuel distributors. The company has consistently raised dividends along with fourth quarter and year-end results around this time of the year. This is a high-growth company that invests heavily in acquisitions. So long as it can find a takeover opportunities, expect dividend growth to remain in the low single digits, which is in line with its historical average. It's also worth noting that Parkland is yet another company that has been materially impacted by the pandemic. Take a look at its revenue chart here. Revenue in the second and third quarters have dropped considerably year over year, and while it is starting to rebound, there is no question that the pandemic has hit the top line. The good news for dividend investors is that cash flows actually remained quite strong. Over the last 12 months, the dividend accounted for only 22% of free cash flow. And through the first 9 months of the year, that dividend accounted for only 30% of adjusted free cash flow. So despite the headwinds, and despite year-over-year declines in revenue and free cash flow, the company's dividend is still well covered. So we do expect the company to raise dividends this coming week, especially because historically the company has only raised in the low single digits. It has plenty of room to continue raising in the low single digits moving forward. Don't expect anything else, but a dividend raise is likely this coming week. And with that, we're at the end of our video. There's 3 companies this week that are expected to raise dividends. All 3 operate in areas which have been impacted by the pandemic. I would say of the 3, the least likely to raise is Chartwell Retirement Residences. The most likely to raise would be Canadian Natural Resources, and I would say the toss-up would be Parkland Fuel. Overall, however, it would not surprise me if all 3 raised, just as it would not surprise me if all 3 did not raise. So please let me know in the comments below what you think. Are all 3 going to raise dividends? Which ones are less likely to raise, and which one do you think is guaranteed to raise dividends this coming week? As always, please like our video and subscribe to our channel. You don't want to miss out on any more great Canadian content. Until next time.